Yeah, so this is a term, maximum decorrelation. And if you search, you'll get like a couple of links. This is where I learned. So he talks about where he picked it up. This is picked up from Scientific Beta Institute. So Scientific Beta Institute is basically an organization of SGX and this EDHEC Institute. They publish indices, single factor or multi-factor and things like that. But I don't know why their focus now has shifted to ESG and low carbon. And they claim their indices are deployed by about $60 billion in assets across worldwide. They do have a very good literature, and not only this, any of these, right? So you can pick it up and try to understand the philosophy of portfolio allocation. Now, this is by the second literature, Resolve Asset Management. This is also a small asset management firm. This paper, about 20 pages. The important thing is this particular diagram. I don't know how to blow it up. I think Control plus, right? Basically, any of this optimization is just a decision making at the start of the year. I mean, if you are doing a yearly rebalancing, so you have the historical data, and then you need to have a view on either returns or the volatility. So, if you have the view on the returns, then go in this decision format, which is mean variance. And then again, you have a view on volatility or correlation. So these are the various optimization techniques. One is mean variance, which we discussed. We haven't encountered into this mean variance or equal Sharpe ratio portfolio optimization. And then finally, you have market cap portfolio. This is nothing but your Nifty 50. Equal risk is equi-weight. And then there are few weighting techniques. So the most common weighting technique is market cap.
Hey, sorry to interrupt. Quick question.
Yeah.
These equal Sharpe is like a risk parity portfolio?
I won't talk about that. I'll just
Okay.
start talking that will take in a different direction. The factor model which I teach and which I deploy, that's a different thing. So you have the various weights. One is your market cap, which is nothing but your Nifty portfolio, Nifty 50 ETF. Let's say you have 3 stocks. With a factor being market cap. So this is, let's say, 10 crore market cap. This is 20 crore. This is 30 crore. And this is 40 crore. Now, if I have to allocate by my market cap weighted, which is the underlying factor, I'll just do my 100 rupees into this divided by sum of all this. This is simple. This is how your Nifty 50 gets constructed. Take the 50 stocks and take the market cap rate and then do an equation like this. This is factor weight. Now you have equi-weight. You don't do anything. You just simply equal weight of your 100. Simple. You will get 25 to each. You also can do, not many people do this in India. You want to take that factor and you want to inverse it. This is very simple. 1 by factor. Now you allocate that into the factor weights like this, inverse of the factor. So for the stock A, which is the lowest market cap, you are allocating the highest money, that's 48. And for the highest stock, market cap stock, which is D, you are allocating only 12%. So everything will put together, it will become 100. So you can experiment the various weights like this. And instead of market factor, you can change the factor to beta and do allocation like a beta weighted allocation. But that's very dangerous. The higher beta stocks, if you allocate higher allocation, you will get killed. That's because of your volatility drag function. So let's say this is date 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And market is guy rating. Let's say this is 5% returns. Minus 10. This is plus 10. Plus 5. 20. Minus 20. 15. Minus 15. 10. Minus. I just took some random numbers. So they all make 0 or?
I think the 7th date should be -5.
Yeah, so if I put -5, so your arithmetic returns are 0. Now 1x is simply this one. Now I start with 100. So my returns would be 100 becomes 105. And then it becomes 91 in the end. That's your geometric returns or whatever. Now the same thing, if you do on 2x, which is higher beta. So your returns will be twice this. Now your equity curve, in the first case you lost 10 rupees or 9 rupees. In the second case you lost more than twice you thought you will only lose 2 times, but you lost more than that. So this is technically speaking, this is called a volatility drag or whatever. So if you, the lesson here is if you wait, which is higher beta, this is what your returns will be. Yes, you will get a good returns here, but eventually it's not like you'll only make money. You'll also encounter in a losing years. So when you encounter a big losing year or a normal losing year, you lose more than what you need. Right. So like that, you can fiddle with other factors as well, the beta, or look back at the volatility, look back at the sharps, look back at the correlation, and get this final weights, either in this fashion, which is factor, or inverse. Unfortunately, inverse factors are not popular in India. And even in US also, the total AUM is, I think, a fraction of less than 1 digit or less than 1 decimal. All right, so this is the way you can you construct those portfolios. Now going back to our stuff. This is the decision making diagram. It's not like this is the end of the world or this is the right, but some guidance. Now, what I have done is I have taken the monthly returns of the popular 4 indices. I just selected them because they are popular. Right, so one is your momentum 30 index, all the monthly values, and alpha low wall 100, alpha low wall 30, gold, and Nasdaq, just for 4 diversified asset classes. The first step in constructing this max Decorrel portfolio or optimization is calculate the returns. Your returns are this month by last month. Then this is your returns column. It's too big. First step. And then the second step is you calculate the Sharpe ratio. That is nothing but today's returns minus the average divided by standard deviation. So the average is, what is the average monthly returns? So average of F. Similarly, G of G, things like that. And then your standard deviation. So you get your Sharpie for these 4 instruments, and then the overall array. You calculate a correlation matrix on top of that Sharpie array. It's a simple, that's what my guys tell me. Who understands the matrix multiplication and all this stuff. So the step is this one. You use MMULT transpose and the array and array divided by count. How many months you are looking at. I will send you these formulas. Right, and then this is a control shift enter function. So, and then when you write this function, write like this. Go here. You have to select all 4 of them. Come here. Type that, copy and paste that function, and then control shift enter. I have no idea why this is 0.04. Should be.
Nilesh, mute yourself, please.
I'm listening to one session.
That should be 1. I don't know why it has come 1.04.
Teams, right? Where he's teaching something.
Raji, can you unmute all the participants? Mute, oh sorry, mute on call.
How do I do that? No, I'll mute Nilesh. All right, so that's your correlation matrix. Then you do inverse. Inverse is a function called MINVERSE of that particular 4 box. The same thing. This is again a control shift enter function. Write in some place, and then go back here, select all 4 of them, function bar, and control shift enter. That's your second step. Then the third step is just weight. We are using the equal weight, we're assuming, and then solving for maximum decorrelation. So this is the step. MMULT, matrix multiplication of that allocation array and MINVERSE array divided by MMULT, allocation array and MINVERSE and transpose total allocation and MMULT. These are you need the matrix multiplication and a little bit of statistics background to understand these functions. Even if you don't understand, you just copy all that you are trying to solve or know is. I'm not becoming an expert in MMULT and transpose or matrix multiplications because that's not my day job. But I know I can copy from somewhere. Or ask any quantitative finance PhD folks, they will explain to you. I don't know whether they can explain the internals, but at least they will explain what this function underlying it does. So this is what it says for as of now. If I were targeting these portfolios, my general preference is to look back 120 years, 120 months. So take all the month-end data, adjust for splits and bonus. Gold and NASDAQ fund have gone through splits. And once you do this procedure, you will get what should be your ideal weight as per maximum decorrelation. Right, so now this equation, if I had followed, I don't know the these weights earlier, but if I had known them, what would have been my returns, right? So this portfolio returns is F. And this one gets locked, function of 4 plus this into function of 4 plus gold into function of 4 plus 100 into this. Now this is your returns. Equity curve. Okay, these are into 100. So your 100 has become 331 as of today. What is the other characteristics of this? Now, indeed. So this would be this into 100 divided by max of I think I should lock this. One by 10 years. So this is giving you about 12% annualized returns. And with an MDD of minimal MDD, 12%. And so your CAGR to MDD, risk to reward is 1:1 kind of stuff. And the best month is max of this one. So you had a 9% best month, and worst month being this one, the 6%. And then I just want only the August. This year it's struggling, but not losing money. Looks profitable in all the years, except this year. But again, if you include dividends, this year would have scraped through.
Cora, just one query
Yeah.
in this max decorrelation formula, you've used the solver function, right?
No solver. It's weight
S22, just S22.
Yeah, it's a weight to inverse correlation.
Okay, so the weight, we've got as a negative weight, right? So how do we, negatively invest in a portfolio? So that's
You have to short.
yeah, but
Shorting ETF is not available.
ETF,
So
yeah,
that's fine.
So, okay, so we'll probably have to limit
just
this.
remove that component and redo this.
Okay. Okay, got it. Yeah.
But actually, if you pick up those weights, right? This and this would be an intersection.
Intersection.
And alpha over 30 stocks would be
right.
30 and 30. So there will be something. So stock A, Reliance is part of both indices.
Okay.
Still, you are asked to short some component in Momo 30 stocks, but that would be very less. So,
Okay.
I mean, you might require 1,000 crore portfolio.
Right.
In which case you are just shorting 2% of Momo. That would be 2 crores, 20 crores. In that 20, you might actually reduce. This is 36 crores, right? 36 into 1,000. That's about 360.
360.
In that 360, you may be investing 330 because
okay. So
right.
Okay. Right.
Your short component will be 10 crore worth of shorts in that Momo 30 portfolio, which are not part of low volume.
Okay, got it.
Now, to test these kind of portfolios, whether it's highly optimized or things like that, what we'll do is this NASDAQ doesn't have the data from 2009. That's the problem here. Otherwise, everything else is there. So this one is 2009. So to solve this dilemma, we will get NASDAQ's data from here. I want maximum. I want a month. Download. This has all the data now. These are not rupee equivalent, so you have to multiply with rupee, but that's secondary. So this will become QQQ. And I want to know what would have been my equation in December 2019, right into the COVID year. So for that, I would feed the data here. Anyway, so there will be some duplicates. You kind of delete them. You don't need this data. This is a very dynamic weighting. So you would have gone with this kind of weighting at the start of December 2019. Now, this is and what is the weight? Mm, 100. No, sum of this. This is very awesome. When the world is burning, you just lost 24%. Right? In March 2020. In that year, they would have generated %30. Not bad. Uh, that's the end of the session. What I would suggest is do this rebalancing on yearly level and don't panic in between. And even if this equation is changing, don't try to rebalance because it adds to transaction cost plus tax implications. Whereas here, you will only pay tax at the end of the year, just 10%. You just delay by 1 day. So you will only pay 30% gains, 10% of it. So 3% tax is what you pay here. Again, these weights might not have changed substantially. So your tax would be little less than 10%. Like let's say straight away we shifted from 2022, 2021, 22. This is what we would have got, right? Basically, you are dumping the entire Momo portfolio and pushing that into lower and NASDAQ. The gold remains the same. So you'll only pay tax on this part, which is 34% of 34% of this component. Yeah, I don't know. Maybe it would have gained. So you started with 34 and you ended with this. Your gains are actually 3 rupees, 4 rupees. So 10% tax on 4 rupees, that's 0.4%. So you don't actually pay 3% as a tax, you pay only 0.4%. Right?
You suggested
Oh, mess of it. Make a mess of it by doing monthly rebalancing or weekly rebalancing. So it becomes like a video game. But you will end up paying a lot of taxes. I don't think you will be able to achieve 150 instead of 130 by doing monthly rebalancing. In fact, you would be achieving far less. Instead of 130, you might end up at 150.
Kola, what are the criteria for picking these four
Right.
asset classes?
Sorry, yeah, can you repeat that? Actually, I will stop the recording so that it doesn't get bloated.